Okay, all right. Well, so today we're going to look at another kind of investment strategy, which should not be a surprise or to a lot of you. I'm sure you're familiar with mutual funds in one way, shape, or form. Hopefully, you'll pick up some new intuition here, and then so we'll talk about what led to mutual funds becoming the popular investment vehicle that they are. What are some of the problems with mutual funds, and what are some recent innovations in the mutual fund world that have made matters a lot better for us? So mutual funds are essentially a package of stocks, a basket of stocks, right? So the question is, why do you want to do that? And the simplest answer is diversification. You want to, we've talked about individual stocks having risks, right? So when you buy stocks, you have a lot of risks associated with them. So the idea is that if you buy a lot of stocks, then some of the stock-specific risks, company-specific risks, can be diversified away through the purchase of multiple stocks. And that will make it a relatively safer investment strategy. So that's sort of the idea behind mutual funds. They're nothing but a combination of, now they don't have to be just stocks. There are bond funds, funds made of different bonds. There are hybrid funds of different investment types, like commodities, and they could be stocks and bonds mixed together. They could be, so, but for the purposes of this class, we will restrict our attention to stock funds for the most part. And so because they're the most common types of mutual funds that are available, so we'll talk about those. But there are other kinds of mutual funds as well in the world. So how are they not Ponzi? Again, they're not Ponzi schemes because there is an actual investment strategy going on here. People are actually investing money. The idea behind Ponzi schemes is you're just taking money in and not putting it in anything. You're simply defrauding investors by collecting money and then paying out to the new investors and then luring newer investors in, but not actually doing anything. Here, mutual funds are actually investing in different stocks, so that's why. I always, there's always somebody asking this question, so it's sort of a preemptive strike on my part. Mutual funds are priced by this quantity called the net asset value, NAV. So because there are these stocks it's a combination of stocks, for example. So what is a share of mutual fund really, what is it? What is a price? And it turns out that the way you calculate the net asset value, which is a price, effective price of a share of the mutual fund. So think of the mutual fund as like a big box of stocks. Now you're going to cut up pieces of that box, not cut up pieces of the stock, but cut up pieces of that box and sell it to investors. That's what mutual fund shares are about. When you think about mutual fund shares, so you have a big box which has a lot of stock certificates, for instance, stuffed with it, right? And then if you could somehow imagine that you're cutting little pieces of that box, the big box, and selling it to investors, that's what buying a share of the mutual fund comprises of. Okay, you're buying a share of the little box, of the big box. You're buying a little pieces of that, and that's buying a share of a mutual fund, comprising of all those stocks inside it. So assets minus liabilities divided by number of shares outstanding. Number of shares outstanding are the number of stocks that this mutual fund has. So NAV is equal to share price. Okay, so for stocks you have share price. For mutual funds you have net asset value, which is equivalent of per share price of the mutual fund. Okay, so let's see here. So the mutual funds have really come a long way. The first mutual fund goes back to over 100 years ago. Harvard College had it for its own employees. 1924, the Massachusetts Investors Trust. Again, the people who worked at Harvard University in those days could have access to those funds, to the mutual funds there. So it was very restrictive. Early on, very few people had access to mutual funds. Today, of course, nearly half of US households own mutual funds in one way, shape, or form, either directly or indirectly through your pension plan, some kind of retirement activity. So you have mutual funds. So indirectly or directly, most of us have exposure to mutual funds. So here are some common, and there's some other statistics that basically show that it's an extremely popular investment tool right now. Some of the common mutual fund myths, the most important one is you can't lose money investing in mutual funds. That's absolutely wrong. You can absolutely lose a lot of money investing in mutual funds because the mutual fund is nothing but a collection of stocks, and stocks lose money. So if you lose, individual stocks lose money, there's nothing to suggest that mutual funds, which are a collection of those stocks, cannot lose money. In fact, they will lose money. They, not always, but they do, just like stocks lose money from time to time. One of the easiest ways to lose money is to invest in the highest risk mutual fund your 401k offers. Now that is also false because just because you invest in the highest risk doesn't mean you're going to lose the money. The reason why people so if you want to make money, obviously there's a direct correlation between risk and return. The more risk you're willing to take, the higher the returns you might be able to make. No guarantees, but yeah, I mean, so there is nothing suggesting that, in fact, taking risks is one way to do maybe moderately well in your investment, but you have to take measured risks, right? So just taking random risks will not help matters. So mutual funds are good so it's a diversified strategy, right? I mean, you're just getting built-in diversification. So you have a ton of stocks in the mutual fund, which hopefully it reduces overall risk exposure, but doesn't eliminate it. That's the whole thing. There's still risk. It's not being eliminated. In fact, it's not possible to be eliminated as long as you have risky stocks in that portfolio. And you're getting professional management, which is important for most of us individual investors, because unless you are a really high wealth individual, you can hire your own money manager. If you have many millions of dollars to invest, you can actually pay and hire your personal money manager and staff to manage your money. But very few people in the world can afford that. So for most of us, we have access to professional management through buying shares of the mutual fund. So that's a good thing for the most part. So again, I'm going to go through these mutual funds. Some of the advantages: it's easy to buy, maintain, efficient, highly liquid. Costs are moderate, and we'll talk about some of these in detail. What kind of funds have very low costs versus others. Risk is usually measured, not eliminated, but certainly there's risk, but there's measured risk. And certain mutual funds can be riskier. We'll talk about some of those. And so one of the ways you can find, so all mutual funds have a prospectus. Prospectus is nothing but a mission vision statement. Okay, so every organization, a company or universities, we all have mission and vision statements, right? So what is our vision? What are our goals? What kind of stocks do we want to invest in? What is our philosophy, investment philosophy? So that's what the mutual fund prospectus will lay out for you. Its objectives, its performances, it'll tell you what kind of stocks it wants to invest in. It'll give you a snapshot view of past performance. It'll tell you how much it'll cost you to invest. It'll tell you turnover rate, like how many shares are being bought and sold. And why do you ask, is that necessary? Because it tells you how active the fund is. If a mutual fund has a high turnover rate, then that'll tell you it's an actively managed fund, and that has consequences. And we'll talk about that. And importantly, current manager tenure. How long has the current fund manager been in charge of the fund? And that's an important metric too. You may say, well, why do we care about that? Well, it turns out that we should care. If we don't care, we should care. And we'll talk about that. And of course, past performance is no guarantee of future performance. We know that with any investment, that's always true. But however, there are certain things that are reliably extrapolated from the past to the future, and we'll talk about that. Okay, so Fidelity. Oh, so you have a shareholder report. Do we need to see that, or we'll just let students. Yeah, you can look at it at your own time. There's a link that you can look at the Fidelity prospectus there, and I'm going to move on. Okay, so when you read a prospectus or any kind of, you try to evaluate an investment in general. Okay, when you're trying to evaluate an investment, whether it's a friend who has a business proposal for you, a friend comes to you with a great idea, or he thinks he has a great idea and wants you to invest money with him, or it could be a she. There's no, and let's say he or she wants your money, or wants you to invest in that idea. So the questions that you're going to ask are pretty universal, or should be. How much money is so if you put in an investment amount in this investment, whether it's mutual fund or your friend's business, how much money is this business going to make for you, right? I mean, what is the expected return on your investment? So that'd be the first question to ask. And of course, if this friend has had this business ongoing for a while, and it's not a brand new business, then you'll want to know what kind of historical returns that business has generated, right? Because that'll give you a clue as to how well or poorly the business might be running. So those are the same questions you ask when you look at a mutual fund prospectus and trying to decide whether this is worth your investment dollars. And those are and they're pretty universal. When you're trying to judge any kind of investment activity, those two questions are front and center. And so, and again, we're going to sort of, do we need to see one? Let's see one of them, just for. All right. So, so with this particular fund, let's see what kind of fund it is first. Let's see. It's a retailing portfolio. Okay, so it's a retail portfolio fund. So it has retail stocks in the retailing industry. Okay. And its management fee is 0.56%. Their expense, so total expense is about 0.86%. Okay, so it's about 0.9, close to 1%. So this will tell me right away, if I were to look at that number, relatively speaking, I would say this is a fairly actively managed fund. When you have close to a 1% management fee, that'll tell you that, that should suggest to you that this is going to be a relatively active fund. So a lot of buying and selling within the fund. And so this is going to be, that 1% is going to come out of your pocket as an investment fee. Because the reason why I'll have you note that is because we'll look at some other types of funds soon to compare costs between this and these other types of funds. But, okay, all right, so let's get out of this. So let's go to the next page. So we'll come back to that when we so keep that retail fund with the 0.86% management fee in mind, and then we'll try to compare that to some other types of funds soon. Turnover rate is another important ratio. It shows how much buying and selling is going on. I remember I told you a few minutes ago that it's a measure of funds activity, how active a fund is, and so so when you have a turnover rate of 100%, that means all of the fund's shares are bought and sold over that last year, which means it's an extremely high activity fund. And so, and then on that front, and so usually the turnover rate is directly proportional to the management fees. So the higher the management fee of a fund, the higher will be the turnover rate. Okay, so there's a direct correlation between those two measures. And load is simply a commission kind of, okay? So loads can be front-end load or back-end load. Front-end load is when you pay to buy into a fund. Back-end load is what you pay to get out of the fund at the back end. So load, and usually you will have, you know, low load funds, which is low cost funds. So load means basically a commission, a charge that we as investors will incur for investing in that fund. So here's a nice box. Here's a nice box to and this kind of a 2x2, sort of a 3x3 actually, box was first sort of brought into style by Morningstar. Morningstar is a well-known, evaluator of mutual funds. They've been in business for the last 25 years, and they sort of are the last word almost in terms of evaluating mutual funds. And they're the ones who sort of made it easier for investors to understand risk and return. And so you have the horizontal axis, which is value, blend, and growth. And then the vertical axis is small, mid, and large. Small, mid, and large are the capitalization of the stocks, the small cap, mid cap, large cap. And then, of course, the value, blend, and growth are the stock types. We've talked about that. Value stocks, growth stocks, and then blend is a mixture of value and growth. So on this box, the top left has large cap value. That's, if you follow the axes labels, you'll see that the green box is the safest of the 9 boxes in the grid. The safest will belong to funds that are in that large cap value box, which is in the top left. And the riskiest would be the bottom right here, which would be the small cap growth. So the small cap growth would be the riskiest in this continuum. Right, so that's sort of the way to. So if you have mutual funds that are in this small cap growth category, you can be sure that they are most risky in this scale. And then the ones that are in the large cap value box are the safest within this category, within this way of grading mutual funds. So that's sort of something to keep in mind. And you can check that FSRPX will be in the morning. So it will certainly not be in the top left, I can tell you that. Right? It'll be somewhere in the middle here, middle to right, so it'll be a relatively risky portfolio fund. And so that's an exercise for you. You can check that mutual fund that we just saw with the ticker, the retail mutual fund, where does it rank in this box. Okay. So one of the ways to denote how, so when you're looking for mutual funds and you want to know how, of course you can see how well the fund is done, right? You can look at the past, the prospectus will tell you, and you can look it up. I mean, in Morningstar, or you can go to Google or any of these commonly available finance sites, and you can type in the ticker, and you can see for yourself how well the fund has performed, or how well or poorly the fund has performed. That's easy. That you can do just as well as anybody else. The question here is, just because a fund has done well in the past, of course, doesn't imply that it's going to do well in the future. That's a guarantee, right? So we know that. Past performance is no guarantee of future performance. However, there is one metric that is more reliably translated from the past to the future, from the past to present to the future, and that is the following. If you look at the manager tenure, how long has the current manager been at running that particular fund? Try to match that with the performance of the fund. So for example, if you see that the fund did really well over the last 5 years, right? Over the last 5 years, the fund has done superb. It's beaten the market every year, so it's done really well. But the current manager has only been at her post for 6 months. The current manager, the manager who's running the fund currently, has only been doing so over the last 6 months. What is a reasonable conclusion? A reasonable conclusion is that all the stuff, other fund performance that you're seeing over the last 5 or 6 years, you cannot attribute to the current manager because the current manager was not there running. So it was done under a previous regime, a previous manager and his or her staff that delivered the performance, who's no longer working for that fund. And therefore, looking simply at performance and trying to extrapolate what's going to happen in the future is not a reliable metric, even from that standpoint. When you see that the manager is not the one who was running the ship at the time the fund did so well. However, if you do find that that coincides, that the manager has been there in place and can be attributed with the performance, then you have a little bit more to go by. It gives you a stronger signal that this manager is pretty good. And the reason we say that is because people's investing philosophy and stuff like that are very personal things. People don't change on that, certainly not on a year-to-year basis. If I'm a fund manager, I'm running a fund, I have my way of doing things. I'm not likely to change that over the next 2, 3, 4, 5 years. Okay? I have a way of doing things, and I'm going to continue to do it the way I do. And if that has delivered great performance, then chances are that it will probably continue to have similar effect in the future. There is no guarantee of it, of course, but at least it gives you a little bit more confidence in the fund's ability to generate returns. And that's why Morningstar and others always tell you the current manager tenure. How long has the current manager been at the post? Because then you can match up that tenure record or the length of tenure with performance to see if there's a match. If there isn't, then that might not be the right fund for you based on that criteria. So that's okay. So all right. So now, so we've talked about active funds that are actively managed. They are fund managers doing a lot of research, the staff's doing a lot of research, there's a lot of buying and selling, and of course that generates active cost for investors. We are the ones, as investors, we are paying the cost for managers trading actively. Then on the other side, there are different kinds of funds called index funds. And index funds are much easier to manage. They're simply, index funds are funds that mimic a certain index. So we've talked about stock indices, right? So we've talked about the S&P 500 index, for example. Well, S&P 500 mutual funds, the index funds, S&P 500 index funds are extremely popular. There are thousands of them. Every fund family has quite a few index funds. Index funds are easier to run because there's no active investment involved. The index or indices don't change frequently. They're fairly fixed. They may change once or twice a year when a stock gets taken out and a new stock put into the index. But that happens infrequently. It's not something that happens regularly. And you don't need a staff to manage that. Okay? You can simply program it into the buying portfolio that if a particular stock is taken out of the S&P 500 index, then that particular stock needs to be sold. And then the new stock that comes in replacing that stock has to be bought to maintain the integrity of the S&P 500 index fund. And therefore, they have low fees. There's not much of active management. These are passive funds. Index funds are passive funds. And therefore, the fund fees are extremely low, much lower than what we just saw, and we'll see that example soon. And also, there's no manager continuity issues that we just discussed. Right? There is no continuity issue because it's an index. You don't need, you can have a trained monkey pretty much running the index fund because you don't have to do any independent thinking for the most part. You're just simply mimicking an index. And you're simply following the same stocks that the index has, you're just putting it in your basket. That's it. So anybody can do that. And therefore, it's cheap. You don't have manager continuity issues. And you have exposure to the market. You have overall broad exposure. So if you have an S&P 500 index fund, you're essentially exposed to the market overall. And we will talk a lot about this, but let me just tell you, the data, if you believe the data, it shows that index funds in the long haul beat out active funds. Okay, so index funds are cheaper. Index funds are if you're planning for retirement, for example, you should have money, a lot of money in index funds, various kinds of index funds, because if you historically look at the data, index funds have outperformed the market overall, historically. So if you have exposure to the market, that's the way to go. It's cheap, and you don't have to worry about a lot of these other issues that plague active funds, including expenses. Now, you have these days another accessible strategy that a lot of fund families, in fact, all mutual fund families now have this available. It's called the life cycle funds. So we have this life cycle hypothesis, right? We've talked about this earlier. Life cycle hypothesis simply means that so it's our life cycle. As we age, as we go through our life cycle, we should, as we get older, we should tamp down the risk that we are exposed to, our investments are exposed to. And as we are younger, we should take our money should have more exposure to risk. So more risk early on in one's life, less risk later on in life. Now, when that change should occur has undergone drastic changes. Now, 20 years ago, it used to be the case that when you turned 40, 45, you were already considered, middle-aged, and you start taking less risks and all. Nowadays, as they sort of jokingly or somewhat half seriously refer to that, 50 is the new 60, or whatever, 45 is the new 60. And therefore, people are living longer, healthier lives. So the conventional wisdom is more or less outdated now. So you can think in terms of investing in a risky way well into your mid-50s, even early 60s, and then start to think about lowering risk exposure. But be that whatever that cutoff point is, more importantly, the broader prescription of the life cycle hypothesis is the following. When you're relatively young, you take more risks with your money. When you're relatively old, you take less risks with your money. You take more risks when you're younger, less risk when you're older. That's it. So if you believe that, these life cycle funds that all of these fund families have accessible to investors will do that for you. What they do is you put in your money in the age of, so they will once you fill out your form and all that with your brokerage or the mutual fund company, they will put your money in an age-appropriate fund for you, right? So if you're in your 30s, you're going to have more exposure automatically. You don't have to worry about it. They're going to put it in the appropriate fund for you. And then as you age, they're going to automatically move your money to lesser risk portfolios. That's what a life cycle fund will do for you. It takes all of the work out of your hands, right? They are doing it for you. And that's the advantage. So that's something for anybody here to think about, seriously, that if you want to invest if you don't have time to invest, but you need to do it, life cycle funds could be an answer, because they take the guesswork out of you, they take the work out of you, they do it for you. So, all right. Okay, so here's some tracking. Are there any questions that I need to answer? So just stop me if you think.
Just wondering what the benefit of life cycle funds are.
What is the benefit? So I just explained. Hopefully that's enough. If not, I'm happy to do that again. Since we are younger now, would it be better to invest in riskier investments? The answer is yes. Again, remember, when you say riskier investments, the answer is a qualified yes. If you're talking about retirement account, for instance, if you open a retirement account, the answer is yes. You should take risks now, because even if the brakes go against you, there's enough time to recover and do well in the market, because you have a long investment horizon. So the answer would be yes from that standpoint. Now, would it be better to invest in riskier investments? Just by itself, the question is a loaded question, because then the question, what is your goal here? Are you trying to, if you're taking risks and you're a risk-taking person, that's fine. But if you are, and so that's where your personal propensity for risk is an important metric to understand before you make investment decisions. That's why when you go to invest money in brokerage houses and you want to open an account where they're going to invest your money, they will make you fill out these huge questionnaires trying to determine your risk tolerance. That is one of the biggest things that investment companies work to understand when they are trying to invest your money for you. They want to understand exactly how much risk you are comfortable taking and what is your investment horizon. Those are the two questions that you need to be very clear in yourself before you get serious about investing. Okay? As you age, and again, as you age, what percentage of your stock should be in index funds, active funds? For example, 40 years old and 60 years old. Well, that's easy. 40 years old will have more in stocks and relatively less in bonds. 60 years old will have relatively less in stocks, more in bonds. So that's sort of now the percentages, there is no mathematical formula that I'm aware of. What you should do is, again, how much risk are you willing to tolerate? And all those kind of questions come in to make the picture somewhat murky. But between those two, I just gave you the answer. I mean, at least what the conventional wisdom is. If one can lose money on a mutual fund, why do some investors say the customer is guaranteed to earn some amount of the... I'm not aware of where they say they're guaranteed. If somebody's telling you guaranteed, they are breaking the law. They're not telling you, and that's something that they shouldn't be. If you can show it to me, I'd be happy to look at that, but I'm not aware of anybody who in their right minds will tell you that there's guarantee, you're guaranteed to make this. Nobody can give guarantees like that, at least legally. So, would you recommend long-term investing or short-term? Well, the answer is I would recommend both. It's not an either-or. It is not an either-or. That's what I keep telling you when we talked about being a trader versus an investor. It's not an either-or. I do not believe in extreme positions on anything in life. It's life, the truth is always in the middle. So you should absolutely have a short-term investment strategy for part of your money and a long-term investment strategy for your retirement. So you can do both. I'll use myself. I seldom talk about myself in this context, but I do have an account that I maintained over the last 15, 20 years, and I call it half jokingly, my play money. And that's money that I used to take risks. I've been doing that for the last 15 or 20 years, about 20 years now. And I just take chances with that money. But I have also serious, investment, retirement stuff that's parked in safe investments managed by responsible people and so on and so forth. So you do both. You have to do both. You should do both. Not have to. You don't have to do anything. But you should, to be strategic, you should definitely have a chunk of money, and how much you have there depends on how much disposable income you have and all that stuff, beyond taking care of your needs and family needs and so on, children and so on. But if you should absolutely do both. There's no reason to, and as your life circumstances change, you can move more or less money into that play fund and take chances. Absolutely, you should do both. Which is riskier, bonds or stocks? Bonds. Stocks. Bonds are safer. They're fixed income. We'll talk about them next. So we'll get a chance to talk about a lot of it. So bonds are considered overall, although there are risky bonds. Let me tell you, bonds can get very exciting very quickly. But overall, bonds are called fixed income securities, and they are relatively safer than stocks. Is a 401k a mutual fund? Yes, it is. 401ks are mutual funds. Okay, so they are invested in mutual funds, different mutual funds. You do not buy individual stocks in these 401ks. Because 401ks are typically managed by investment mutual fund companies like TIAA, Kraft, and all these companies that manage, and so you buy different mutual funds. And you can change those allocations. All right? Okay, how can we buy bonds? There are different ways you can buy them there's some online places you can buy bonds. They're not as transparent as stocks. You can call your local brokerage houses. They can hook you up with some bonds if you want. You can buy treasuries from your bank. So there are lots of ways, and we'll talk about that when we get to the bond section. So here's some. So mutual funds. We've talked about the active versus passive funds. So you have active funds, which of course a fund manager will tell you, oh, we do really well. But if you look at the academic studies, and my personal view is that your money's probably better spent in or better invested with the index funds. That is not to say that all active funds are bad. If you know what you're doing and you do your research properly, you might be able to unearth some funds, active funds, that might get you a pretty decent return on your investment. But overall, this is overall, okay, not picking individual stocks, mutual funds, active versus passive. There can always be exception to this rule. But overall, if you look at the literature, if you talk to professionals, the idea is that your money's probably better invested with passive funds, like index funds, than with these active funds where you have to pay a high cost. So beware of high load. So the big question is, if markets are efficient, why have some funds outperformed the S&P funds over long periods of time? Now this is a question that I'm not even sure if it's properly posed, because a lot of active fund managers will tell you, well, you know, we have outperformed the market. Well, the question is, the problem with statistics is that if you know enough about statistics, you can get the data to say whatever it is you want to say. You can slice the data, you can look at sections in a way that will give you exactly what it is you want to transmit out there in the world. So I'm not even clear that when people make the claim that, you know, active funds have outperformed the market, I'm not even sure if that's a claim. Just because a fund may have done well, better than the market, over 2 or 3 or 4 years doesn't make it such that, oh yeah, this is a great fund. You know, if you toss a coin 100 times, you can get 90 heads. You can get 90 heads. 90 times heads can come up. What does it mean? It means nothing. Just because it's still a fair coin, you still have a likelihood of half and half, or, you know, half the time heads and tails. But just, you know, the fact that you have 3 or 4 years where the fund has outperformed the market does not guarantee, does not generalize the rule and say, oh yeah, this must be better than the market in general. No, I mean, you can have a run of good luck. That's simply what it is. And so, but fund managers will try to argue against that, of course, because that's the business they're in, and they have to get clients for their mutual funds. But so again, like as I said, that you know, this argument between active funds and passive funds will go on. It's not going to be settled anytime soon. You have to make that determination as to whether you want to put your money in index funds versus active funds. And the answer could be you could do both. You could simply have some exposure to some active funds which you have done the research on and feel reasonably confident about, and then have the rest of the money in suitable index funds. All right, so now what are some of the, we've talked about these traditional mutual funds, okay? What are some of the problems or criticisms of these mutual funds? One major criticism is that these funds price once a day. Funds price once a day. What does that mean? It means that when you place a buy or a sell order for a mutual fund, a conventional mutual fund, the type that we just discussed, you have to wait for your order to clear at the end of the day. So at the end of the day, the closing prices of all the stocks will be determined. Then the net asset value of your fund will be computed. And then the price will be determined and your order will clear at the end of the day. So it doesn't matter when you place the order to buy or sell, the order will be cleared only once a day at the end of trading on any given day at the closing prices as determined by trades that day. That creates a lot of problems for investors who may want to take advantages of certain moves during the day. Certain events happen during the day and you want to get in and out quickly, but you can't do that with conventional funds, because you have to wait for the markets to clear and markets to close, and then you have to. So that is a huge problem, which is why active investors, serious institutional investors, usually have avoided mutual funds because of that problem, that you cannot take advantage of market developments during the day to buy or sell these funds because you have to wait. So what do? Well, enter exchange-traded funds, ETFs. These have now, these are now replaced, almost, not replaced, they still have their, but they have become extremely popular. They are essentially a hybrid of mutual funds, traditional mutual funds, and stocks. So one of the biggest advantages of these ETFs are they're mutual funds. They are mutual funds, but they're mutual funds that trade like stocks. So they trade throughout the day just like a stock. They are priced throughout the day just like a stock, but they're mutual funds. And this has been an answer. These are extremely popular. So these ETFs are now on all of the sectors, different sectors. As you can see, there's a few examples here. The cubes are very, very popular. There's 4 Qs actually now, not 3 Qs anymore. But they are the NASDAQ 100. So that the cubes track the most active NASDAQ 100 stocks, 100 most active stocks. Then the diamonds are the Dow Jones average. They track that. The Vipers are other indices. So you have these they're all index driven. These ETFs are all tracking different indices, but they trade like stocks, which means that they are subject to the same vicissitudes or uncertainties that plague stocks. Like, for instance, they can be overpriced at some time, they can be underpriced, they can be all that, all depending on demand and what happens to the markets. All those things can happen, but these are extremely popular. These ETFs have become extremely popular with investors, and especially serious investors, because of its ability. You can buy and sell them during the day, anytime you want. Their price is available at any time of the month, any time of the day. All right. So here's some, and of course, because they're tracking funds, index funds, they have low fees, and so the disadvantages are not really anything unusual that you can't say for stocks. So and then you have bond ETFs. I told you about, you have bond mutual funds, so you have bond ETFs as well. Change it to bonds. Yes. And so, again, they're tracking some bond indices, and we'll talk more when we get to the bond section, which is, I believe, the next one. So we'll talk more, but So ETFs are really the way to go now, unless you have some very compelling reason to. And for individual investors, frankly, if you're not going to be interested in timing markets and trading actively, S&P traditional mutual fund index fund is as good as anything, because you're not concerned, you're not sensitive to market movements during the day. You're simply buying and then you're going to hold. If you have a buy and hold strategy, then clearly, you don't need to trade ETFs. If you're going to be an active investor, then yes, you might think about ETFs. Okay, but if you're going to buy and hold in some kind of a long-term hold position, then really, mutual fund, traditional funds are just as good. So depending on what it is you're looking for, either one could serve the purpose. All right, so hedge funds. Hedge funds, I think I may have just mentioned it in passing, but hedge funds are nothing but mutual funds for the super rich, and they are by invitation only. So unlike these hedge funds, unlike these ETFs and mutual funds that we just talked about, that anybody can buy shares to. You and I can buy shares to it as long as we satisfy minimum investment criteria and all that stuff. We can buy and sell those things. Those are meant for everybody, okay? Hedge funds, on the other hand, are by invitation only. Hedge funds, you and I may not be able to access them because hedge funds are meant for, they're usually by invitation only. They're usually for wealthy people, run by fund managers who are paid by these wealthy people to run their funds. And so for the longest time, hedge funds flew under the regulatory radar, because the thinking was, well, it's sort of the playground of the super rich. Let them play out there somewhere in the sandbox. We don't need to worry about them. So a lot of regulations were not targeted to the hedge funds. They were allowed to play simply because they were out there playing, and that was the thinking. Until suddenly people realized, to their horror, that these hedge funds had become extremely lethal and were affecting markets overall with their very aggressive strategy in weaving in and out of markets, and they were just buying and selling and dumping stocks to price manipulate and stuff like that, and trying to generate returns for their investors. In the process, they were really destabilizing the markets in a serious way. That's when the government suddenly realized, no, they're not as innocent as we thought them to be. Collectively, these guys are generating trillions of dollars in business, and they are affecting the overall markets and destabilizing the markets. So therefore, suddenly it was like, oh my God, we need to regulate them. So a lot of light was started shining on these hedge funds and their practices. You may have seen a lot of the hedge fund managers have recently been indicted. They've been sent to prison for insider trading and manipulating stocks and prices and so on and so forth. And in New York, you've had the the Attorney General of New York State has made a name for himself for going after the mutual funds and mutual fund managers. Oh, I'm sorry, not mutual funds, hedge funds, hedge fund managers. You may have read about the Galleon Group. The hedge fund manager of the Galleon Group was recently found guilty and sent to prison for insider trading and all that. So that's just a tip of the iceberg, but that's been happening, and a lot of the hedge funds have now been put under notice for shady practices and things like that. So let's stop here since we're almost out of time, and we'll pick